Chris from Adapt Tuition here, and today I'm going to be showing you how to do revenue accounts. Okay, so what is revenue? Revenue is any money earned by providing a good or a service. Quick question, what's the difference between a good and a service? Well, a good is anything that has a physical property. That is, for example, your phone, right, or pens, clothes you wear, the shoes on your feet, all those things are goods. They have a physical property, they are tangible. All right. Services are things that don't have physical property, or they are not tangible or intangible rather, right? For example, if you go and you get a haircut, right? The person did something to your hair, they cut it, they clip it, they shave it, they give you a mark, whatever the case is, they color it, all that stuff. That is a service. It does not have a physical property, but at the end of the process, you see a particular result that you wanted, okay? All right. Now, like I said in the definition, revenue is earned. That means you make the money becomes yours when you provide that good or that service. And you would like to receive the money you have earned from your clients, right? So the thing is, sometimes we don't receive all of the money one time, we receive it piece by piece. In which case, what would happen is we would have accrued revenue or revenue owing to us. Sometimes people pay in advance or they pay too much. And in that case, if they pay before the service is rendered or before the good is delivered, then we have prepaid revenue. And we also have to learn how to account for those things, because accrued revenue, when someone owes us money, that's an asset, all right? And the thing is, when someone pays us in advance, we now have an obligation to give them a good or a service sometime in the future. And that is the definition of a liability, right? So how do all these things play into revenues now? Well, we're going to take a look at some examples, and we're going to see how to account for it in T accounts, as well as the income statement extract and the extract of the statement of financial position, normally called the balance sheet extract, okay? So, just a point to note, some housekeeping. This video will not include any CSEC past paper questions as examples. I will do a separate video showing you all how to do past paper questions, how to do the solutions for certain past paper questions that will require you to do revenue accounts and expense accounts. If you're looking for a video on how to prepare expense accounts, you can check that card up there or a link in the description below. Okay, so watch out this video and then go and check that one, or you can check that one and come back. Up to you. Okay, so let's get into it. Okay, so on to the first example. So this is where the amount received is equal to the amount earned. Okay, so are you there? Are you there? Rents a room to a tenant for $24,000 per year. Okay, so from that sentence alone, this tells me how much the how much the landlord is going to be earning. So this $24,000 is earned every year, right? Now, during the year ended December 31st, 2018, the tenant pays a total of $24,000. What a good tenant. They paid us exactly how much was owed. So what we have to do is prepare the rent revenue account. So I know you're seeing the rent revenue account up on the right-hand side here, but before we get to that, I like to do a bit of analysis, right? I don't just like to jump into T accounts and debits and credits. I like my students to understand why we do things, or even if not why, the way things work, all right? Because accounts is not supposed to be some esoteric or abstract subject. It really is a system of keeping track of the ins and outs of finances, of money, which is something very important, okay? So just a basic analysis here. So we're checking to see if we received enough or too much or too little, right? So the amount earned was $24,000. We got that because that was the agreed upon amount for which the tenant would rent the room. And how much was paid to us? Well, that was $24,000. I'm saying us, but I mean, are you there? Right? But it's going to get very repetitive of me saying, are you there? So I'm just going to say us, all right? So we received $24,000. And I'm putting the receipts in a negative figure because I want to see if there's a balance left over at the end, all right? So let's just do a quick sum here. All right, so there's no balance left over, no excess, no deficit. So that means there's not going to be a balance at the end. All right. Now, rent revenue account. How do we enter this information inside of this account up here? All right. On what side does it go? So we know we have two sides to every account: the debit side and the credit side. Now, what are the double entry rules that revenue accounts follow? Well, credit to increase and debit to decrease. Now, just a quick word on why revenue accounts follow those rules. Revenue ultimately helps us to earn profit. And the more profit we earn will increase the owner's investment or the capital. And capital increases with credits. So anything that will increase capital will follow the same rules as capital. Credit to increase, debit to decrease. anything that decreases capital will follow the opposite rules. For example, expenses. With expenses, you debit to increase and credit to decrease. Okay? So, now what goes on what side here? Now let's talk about the amount received, right? So the amount received would have gone to the cash book, and it would have gone on the debit side of the cash book because it was a receipt. So if it goes on the debit side of the cash book, guess what side it goes on here? It goes on the credit side. So we're going to credit here for $24,000. Now, the amount earned goes on the debit side. Why does it go on the debit side here? Because when you transfer to the income statement, it's a credit to the income statement. And if it's credited there, it has to be debited from the other account. Well, it's coming from the rent revenue account, so we have to debit it. Debit this account, and it will say income statement. All right, so now we're going to put $24,000 there. All right, and what's going to happen is that the total on both sides is going to be equal. So there's not going to be any balance carried down, which we already knew from this side across here. No balance at end. All right, so the income statement extract. Now, at the end of a financial period, all revenues and expenses must be transferred to the income statement to calculate profit. Right? Now, revenues earned are transferred and expenses incurred. Now, we earned $24,000. As a matter of fact, this $24,000 has as its label income statement. So this amount goes to the income statement. Right? $24,000. Right? Now, notice this income is an income statement extract. It's not the whole income statement. And this piece that we've added on here comes after gross profit. Right? So if they ask you to show the relevant extracts to the financial statements for additional revenues, those things go after gross profit, right? And the other examples that could go here of additional revenues are commissions received. A very popular one, this isn't exactly a revenue, but it's an item that will actually increase profit, is a decrease in the provision for bad debts. I will try to get a video out on that and link it in the description, because I know that tends to be a bit of a trouble area. Anyhow, so let's get on with it. Now, do we need the balance sheet extract in this particular situation? Well, we need a balance sheet extract if there was an accrued or prepaid portion to the revenue account. Right now, the debit side was equal to the credit side. We received exactly what we earned. So there was no excess, there was no deficit. So therefore, there's no balance at end, no accrued or prepaid portion. So therefore, there's no need for the balance sheet extract. That will only be relevant or necessary if there's an accrued or prepaid portion, which we actually will see in the next example. All right, so let's get to that one time. So we're going to click across to that one. Let's just clear the stuff across here. All right, so in this case now what we're seeing is amount received is less than the amount earned. So if we receive less than we earn, it means we still owed some money. So let's take a look. Are you there, rents a room? So same basic information, we're earning $24,000 per year, but during the year ended, right, the tenant pays $20,000. So let's see what happens here. So if we earn 20, whoops, what happened there? Okay, hold on. Let me just zoom out slightly. All right. Right, so $24,000. Okay, and we received $20,000. So 24 minus 20 will actually give us $4,000. And that's going to be an accrued balance at end. Why is it accrued? Accrued means owing or unpaid, or in this case, unreceived. So we earned $24,000. That was the amount we were supposed to get, but we only got 20. Therefore, there's still an excess of 4, or there's a deficit of 4 that is left owed to us. And if any money is owed to us, that's going to be classified as a current asset. So we know, therefore, the implication is a balance sheet extract will be necessary if one is required. Okay, so let's enter the information into the revenue account. So let's start on this side. So the income statement figure is $24,000. That's how much we earned. The cash book figure, we got $20,000. Whoops, I missed out a zero. $20,000. And let's see the total. All right, so the total on the debit side is $24,000. Credit side is 20, which means therefore we need a balance to be carried on from this side. And how much we need to be added to 20,000 to make 24? 4,000. All right, so we bring the balance down on this side. Boom. All right. So what goes into our income statement extract, right? Because we only received 20,000. Now, the thing is, the accruals concept says that regardless of how much was received, the amount earned must be put in the income statement, right? The income statement is prepared using something called the accruals basis of accounting. right? So if you guys don't know what that is, do a little Google searching, read the textbook, read the notes. I will try to put out a video on accounting concepts. Right now I can't say exactly when that'll be, but when it happens, I will link it in the description, right? Or feel free to check my channel, check the videos or playlist, and you might see it there. Okay, so we earned 24,000, right? Like I said, this figure 24,000 says income statement. So that is the amount that goes inside of there. All right, now what goes here? Now we're seeing a debit balance. Now what does a debit balance imply? Asset or liability? Well, assets have debit balances. And as we said earlier, because the person or the tenant still owes us $4,000, once we are owed money, that is an asset. All right, that's a benefit we can reasonably expect to receive within the foreseeable future, which means we're going to have a current asset section, and that is going to be accrued revenue. So accrued means unpaid or unreceived, right? So that amount is $4,000. Boom. So there you have it, right? So we put the income statement figure, the amount earned on the debit side of the revenue account. The cash book figure, the receipt goes on the credit side, right? We receive less than we were supposed to, which means we have a balance carried down on the debit side, and it's an accrued revenue balance, right? The income statement extract has the full 24,000 because we need to put in the total amount earned regardless of how much was received. Balance sheet extract, well, we have an accrued revenue, which is the current asset, so we will show that figure in the current asset section. Okay, so that's where we received less than we earned. What about if the reverse happens? What about if we receive more than we were supposed to, right? So we clear out here. Right, amount received greater than the amount earned. So are you there, rents a room to a tenant? 24,000 per year, same basic information. During the year ended December 31st, 2018, the tenant pays a total of $26,000. Ooh, okay. So let's take a look. Analysis. Whoa, why does it do that? All right, so let's just zoom out a little bit. All right, so $24,000. We received $26,000. So think about it. If we receive more than we were supposed to, it means that the amount for rent revenue has been overpaid. Or maybe the tenant has paid in advance for the following year, 2019, which means there's going to be a prepaid revenue at end, right? And we can see that, $2,000, right? So anything that as a receipt or being paid to us, I have as a negative figure, all right? That means it's money coming in, right? So no, we're not losing money, but it's kind of being netted off against the amount earned, which is the positive figure, all right? Okay, so we know well, we have an idea about how our rent revenue account is going to look. So let's go there, right? So income statement figure is 24,000. The cash book figure is 26,000, right? So what's going to happen here now? We have 24,000, 26,000, which means that the balance must be carried down from this side. Now we need $2,000 to make this account balance, and it's going to be brought down on the credit side. And a credit balance at start implies a liability. And like we said, prepaid revenues are current liabilities because they represent amounts that we have to transfer in the future to some other party other than the owner, right? Now, how much goes in the income statement extract? Now, regardless of how much was received, the amount earned goes in the income statement. That's $24,000 right there, right? So, note, regardless of how much was received, we received 26,000 in this example. In the previous one, we got 20,000, but in both examples, we earned 24,000, and that goes in the income statement. Right, now what goes in the balance sheet extract? So we said it's a current liability because it is, technical difficulties, prepaid revenue, all right, and that's $2,000 right there. Okay, so how are we looking so far? We're getting a feel for it, all right? So these things up in the rent revenue account don't usually change sides. The balances, however, will differ, right? So let's take a look now. So in these cases here, we didn't have any balances at start. But of course, the questions that come in CSEC like to have balances brought down. So what we're going to do is take a look at an example of that type of information. So we're going to have an accrued balance at start. Let's take a brief read of the information. Are you there rents a room to a tenant for $24,000 per year? Same information. At the start of the year, the tenant owed $2,000 in rent. Okay. During the year ended December 31st, the tenant pays a total of $25,000. Prepare the rent revenue account. Okay. So first things first. The amount earned is $24,000. That's what they told us up front, right? Next, at the start of the year, the tenant owed $22,000 in rent. So that's going to be an accrued balance at start, which is $2,000. Now that's a positive figure because that's an amount we have to get. That's something supposed to come to us, right? So if it's supposed to come to us, those are positive figures. When it comes to us, those are negative figures because they kind of net off. All right. Amount received, we got $25,000. Yeah. All right. Now what's going to happen here, right? So we were supposed to get 2,000 from last year plus 24, which will give us 26 in total. We got 25. Is that enough? No. We're still missing how much? $1,000, right? That's an accrued balance at end. So we know what's going to happen here. Now let's take a look and see what's going to happen. So in the accrued balance, in the rent revenue account, sorry, the accrued balance at start, accrued revenue is a current asset. Current assets or assets in general have debit balances at start. $2,000, right? The income statement figure is 24,000. The cash book figure is 25,000, and that gives us 26 on the debit side, 25 on the credit side, which means this side needs how much? $1,000 in order to be balanced, right? And of course that comes down here. That's $1,000. Okay, that's the rent revenue account. Balance at start, income statement figure, cash book figure. We needed a balance of 1,000 to put the account in balance. Okay, rent revenue. How much goes here? $24,000. Regardless of how much was owed at start, owed at end, or received, the amount earned goes in the income statement. All right. Now, what's going to happen here? So, accrued revenue, sorry, is a current asset. All right, and that's $1,000. All right. So this is how the setup, the solution looks for this particular question. All right. So that's where we have an accrued balance at start, and we ended up with an accrued balance at end. Right? Because once again, the total amount that was due to us was not received. We received a little less, which means we're going to have accrued balance at end here. Okay, now let's take a look at another example, which is where we have a prepaid balance at start. So what's the information saying across here? Ayurveda rents a room, same 24,000. At the start of the year, the tenant had prepaid 3,000 in rent. So maybe they had some extra funds at the start of the year or the end of the previous year, and they say, look, hold some money for 2018. Okay, no problem. During the year ended December 31st, 2018, the tenant pays a total of $25,000. Okay, so if the tenant pays $25,000, that's the amount received. So let's fill it. Earned is $24,000, received is $25,000. Hold on, we forgot the prepaid balance at start. Now, a prepaid balance would be, in this case, a negative figure because it represents an amount we received already. Right, so that kind of nets off against what we have to receive. Now, check this, right? If we already got $3,000 in respect of this year, and we were supposed to get $24,000, then you just have to net it off. 24 minus 3 means we were only supposed to collect $21,000. And that would have kind of put us at a neutral, no prepayment, no accrual. But look at that, we received $25,000, which is $4,000 more than we were supposed to get, which means this account still is going to have a prepaid balance at end. Well, let's take a look and see how the account looks now. So a prepaid revenue is a current liability, and liabilities have credit balances at start. Right? The income statement figure is the same 24,000 on the debit side in this particular case. Cash book figure we got is 25,000. Now, what's going to happen here? Right, look, we have 24,000 on the debit side, but 28 on the credit side, which means there's a balance to be carried down from here of $4,000. And it's going to be brought down on the credit side because it's still prepaid at end. Prepaid revenue is a current liability. Now, income statement extract. Well, guess how much goes here? Same 24,000. All right. Balance sheet extract now. Let's see. We have prepaid revenue. That's a current liability. And the amount for that is $4,000. All right. Okay. So what we've covered so far, right? And we almost at the 20-minute mark. Wow. Okay. I have a few more examples to go. So let's get it. But once again, what we've covered in this example was where we had prepaid balances at start and at end. We had to actually kind of find the ending balance, right? So I'm hoping that you guys, if you guys had any issues about how to balance off T accounts, I'm hoping these examples are providing some help for that. Apart from helping you to understand how we prepare or enter information into revenue accounts. Okay, so now what we're going to take a look at is what CSEC does quite a bit of the time. They ask us to find the income statement figure, the amount earned in the case of revenue. So this example is they will find revenue earned 1. So Ayurveda rents a room to a tenant. Oops. Well, normally we were told how much the room was rented for, but here we aren't told. Here we don't know. At the start of the year, the tenant owed $3,000 in rent. Okay, so the tenant owed us at the start of the year, that's going to be what? Accrued, right? Accrued at start, and that's $3,000. Oh, I forgot to zoom out. Yeah, let's do that. Okay, so the tenant owed us $3,000. During the year ended December 31st, 2018, the tenant pays a total of $26,000. All right, we don't have amount earned, we have amount received, $26,000. All right, and then at the end of the year, this tenant still owes $2,000. So that's an accrued balance at end. All right, so how much do you think we actually earned? Now you can try to figure it out here. Okay, so they still owed us $3,000 from last year, and we got $26,000, which means we could take $3,000 out of this to show what was paid towards this year, which will give us $23,000. But we were still short $2,000 at the end of the year. So if we received $23,000 in respect of the current year, but we were still short $2,000, it means that this figure was supposed to be $25,000. All right, now let's check it out. If we delete that figure and we do a sum here, 2,000. So it works. Let's check it out in the T account and make sure it ties back. Right? Now, just by the way, you guys don't have to actually physically write these things out in the exam. I am just doing this, once again, like I said, to help you all process mentally how to approach these things. It's not all just supposed to be about double entry and T accounts and debits and credits. It's supposed to be about thinking through something. All right? Anyhow, so accrued revenues are current assets which have debit balances at start, and the income statement figure we don't know. The cash book figure was $26,000, right? And we had an accrued balance at end, which we were told was still $2,000. Okay, so what's going to happen here now? Right, so check it. On the credit side is a total of $28,000, and here total of $3,000, which means we need how much a balance of? $25,000. Now that's the income statement figure. We already have a balance carried down of $2,000. So please don't put your income statement figure as your balance brought down, right? Pay attention to what you're doing. Now, rent revenue, how much goes here? Well, $25,000, because that's how much we earned in this particular question. And what's going to go in the balance sheet extract? Well, we have a debit balance in the rent revenue account, which implies a current asset, and that's going to be accrued revenue to the tune of $2,000. All right, so that's example one of when we had to find the income statement figure given opening balance, closing balance, and amount received. So let's take a look now at another example with prepayments. All right, so let's just clear out this sheet so we have a fresh space with which to work. Okay, so rents a room to a tenant, so there's no figure for rent revenue. Okay, start of the year, the tenant had prepaid $2,000. Okay, so let's zoom out first, right? Okay, cool. Right, prepaid. So we said prepayments, so payment figures are negative in this particular case. Amount earned, we don't know. During the year ended December 31st, 2018, tenant pays a total of $27,000. And the amounts that the tenant still had $1,000 prepaid at end. All right, so let's see if we can kind of logic this out here. So the tenant started off owing us, had prepaid $2,000 for this year. So how much ever they earned, how much ever they had paid, would be extra on top of that. So technically speaking, they paid us $29,000 towards this current year. And then at the end, the prepayment figure, the extra was $1,000. So if they paid $29,000 and still had $1,000 left over, it implies that $28,000 was the amount that was supposed to be paid. Now let's see if we add up everything there, what do we get? A $1,000 prepayment balance. Let's see if it ties back with the T account. So rent revenue, if it's prepaid at start, that's going to be a current liability. That's $2,000. The amount received, what's going on? Right. Amount received was $27,000. Right. So we don't know the income statement figure. We do know that there's still a prepayment at end of $1,000. All right, which means, look at that, we have $1,000 on the debit side, $29,000 on the credit side, which means we need $28,000 to make it balance, which was what we got down here in our analysis. So it worked, right? So this figure across here for the balance carried on is $1,000. Still on the credit side, which implies it's a current liability. Income statement extract, so we know that amount is going to be $28,000 from on top of here. Balance sheet extract, so we have prepaid revenue at end, which is a current liability, and that is to the tune of $1,000. All All right, so we had a second example of how to find the income statement figure given opening and closing balances as well as the amount received. Okay, all right, so let's just check out two more examples, right? Okay, so in this particular one now, okay, here we have to find the amount we received from the client, from the tenant in this particular case. All right, so are you there rents a room to a tenant for $24,000. Okay, so the amount is 24. Oops, I forgot to zoom out again. Keep forgetting that. Anyhow, amount received, hold on. At the start of the year, the tenant was in arrears. So in arrears means the tenant owes us revenue, which means that's going to be an accrued balance at start. That's $4,000. At the end of the year, oh, I wrote it at the end of the year, we're still owing $2,000 in respect of rent. Okay, that should have been at the end of the year, the tenant. Right, we're still owing $2,000 in respect of rent. Okay, so it means therefore that we have how much? $2,000 here. Okay, so check it. Analysis time. They owed us $4,000 at start, and they had $24,000 to pay for the current year. That's a total of $28,000. How much ever they paid, they still owed us $2,000 at the end. So if 28 was supposed to come in and they paid some amount and it was lacking by $2,000, it means that they paid $2,000 less than what was owed, which would be $26,000. So if we take that figure out there and we add it back up, we get $2,000 accrued at end. So let's put some stuff inside of it. So accrued balance at start is $4,000. The income statement figure, right? So that was back in this question, 24,000. Cash book figure, we did not know. The balance at end, it was still owing to us, which was $2,000, right? So, right, 28 on the debit side, 2,000 on the credit, which means we need 26,000 to make it balance. All right, and that would be the cash book figure. Now, income statement extract, how much goes inside of here? 24,000, and we have accrued revenue at end, which is a current asset to the tune of $2,000. All right, so we have one more example to go. Now, of course, there are many different things I could have done, right? But one, I didn't want this video to go on for too long, and secondly, when you guys have a command of the basics, then you can try some slightly more complicated stuff, right? So I wanted to keep this relatively basic and slightly intermediate. Okay, let's switch now to the last example. Let's clear out our working space. Okay, so are you there? Rents a room to a tenant, 24,000 per year. Okay, that's the income statement figure. That's the amount earned. Forgot to zoom out again. All right. Amount received at the start of the year, tenant had prepaid 3,000. Okay, let's put in our prepaid balance at start, which will put us a negative figure. All right. So at the end of the year, 2,000 was in advance. I didn't word this problem. I'm sorry, but at the end of the year, the tenant was still, let's put the tenant, right? The tenant was still $2,000 in advance in respect of rent. Okay, all right, that could work. So it means here we have $2,000. Oh, and that's supposed to be prepaid. All right, so let's take a look and see if we could figure out the received amount. Okay, so if they had prepaid $3,000 last year and they need to pay us $24,000 for this year, it means that they only have to pay us $21,000 for the current year. Now, how much ever they paid us, they still ended up being $2,000 over. So if they owed us $21 and then they paid us an amount and it was still $2,000 over, it means they paid us $2,000 more than was owed, which should be $23,000. All right, let's take that out. Let's add it back up. And we get back the same $2,000 there. All right, so prepaid revenue has a starting credit balance. The income statement figure is on the debit side here. The cash book figure had to be figured out. And we had to do, we still owed, the client had prepaid $2,000 at end. All right, so 26,000 on the debit side, 23 on the credit, which means, 3,000 on the credit, which means 23,000 is the cash book figure. All right, so that's going to be balanced off $2,000. Rent revenue is 24,000, and they have prepaid, which is a current liability for us. Prepaid revenue $2,000. Okay, wow, just hitting the 30-minute mark there, guys. Wow, so this has been a relatively long video, twice as long as my longest so far. But I do hope that you've understood what I've gone through today. I do hope you're finding these videos valuable. If you're looking for full past paper solutions for some of the most recent CSEC PoA exams, please feel free to check out my Facebook page, A Different Approach Tuition Limited. Right, I have put up the 2019 Jan, the two 2018 papers, two 2017s. 2016 has an issue. I'm trying to put that up as soon as possible. The 2015, 2014, 2013 papers are there. If you guys spot any errors or if any questions are missing for whatever reason, please feel free to let me know. I'm only human and sometimes I do have errors and omissions. But of course, I mean, I'm happy to fix those things. Please like and subscribe. Like this video, subscribe to my channel, please. I'm also on Instagram. I do some art math stuff as well. I'm just trying to put out as many PoA videos as I can because most of the requests have been for PoA stuff, and I'm trying to give you guys what you want. All right. So I want to thank you guys for watching this video. It's my pleasure to make them. I like helping people. And until the next time, good luck in your studies. And if you have any questions, any requests, put them in the comment area below. Okay guys, have a good one. See you next time.